Good morning. It's Jeffrey Christian, CPM Group. Welcome to our 2023 briefing on our 2023 Gold Yearbook. We have been producing these reports since we started as CPM Group in 1996, 1997. And of course, they predate that, going back to our time as J. Ahrens Research Department in the 1970s into 1981, and then the J. Ahrens Goldman Sachs Commodities Research Group, 1981 through 1986, when we spun off and set up CPM Group. We have to thank our sponsors and our partners. We work with the China Gold Association, China National Gold Corp group in China, as well as Beijing Yicheng Technology, a company that provides gold and precious metals related technological solutions. And we have sponsors from around the world: the Institute for Scrap Recycling Industries, Kitco, some refiners, Coralin Economics Report, Monex Precious Metals, Metallic Minerals, and Rena Gold. New sponsors this year: mining companies, exploration companies, Noah Capital Markets, which has been the institutional investor that investment bank that we have worked with in South Africa since 2004. Sabin Metals, which we've worked with since gosh knows when. Longtime proud sponsor of CPM Group. Idaho Armored Vaults and the Gold and Silver Vaults, as well as Profit Plus Capital Management and Profit Plus Precious Metals. Sponsors across the market: mining companies, scrap refiners, providers of precious metals and bullion and precious metals equity investment strategies. We work to have a diverse group of sponsors that cover every aspect of the market. We also have media partners: the Northern Miner, Kitco Metals, Metals Daily, and Prospector News. And we have distributors that are not media partners, but that promote and distribute our reports: Gold Blocks, Gold Silver Central in Singapore, Interact in Southeast Asia Consulting in Singapore as well. We want to thank all of them. We will have a question and answer period. There is a question drop-down box on your on the webinar console. You can type in the questions. There's no audio questions. We have about 80 questions that were sent to us ahead of this. We'll try to pick some of the better ones there, but we'll also, obviously, pay attention to questions that people might write in as we speak. Typical for what CPM Group has done for the last many years, Rohit Savant has been the primary author of the Gold Yearbook. He will make the bulk of the presentation. I'll have some initial comments on the price of gold, what it did last year, where it is, what we expect this year and beyond, as well as the economic, financial, and political environment that heavily flavors investment demand. I'll kick it over to Rohit for the bulk of the presentation. I will interject myself a little bit toward the end, I think, with some central banks activity, and then we'll open it up for questions. And we'll go for as long as it takes. It's a lot has happened in the gold market over the last year or so since we produced our last report. Lots happening, a lot's not happening, but it's said to be happening. A very interesting period of time to be involved in the gold market. There are two groups of people that we talk to. Well, there are many groups of people that we talk to, but there's one way that you can slice and dice it, is you can talk to people, oftentimes mining companies, jewelers, refiners, long-term investors, and they will say to you, yes, the gold price was a record $1,804 last year. It was up slightly from $1,799 record price in 2021, but it was up quite significantly from previous years. And you can see on this price chart there. The other group of people say, God, the gold price is so low. I mean, it was $2,060 for at least a second in early March of 2022 when Russia had invaded Ukraine. And by November 3rd, it was down to 1623. The gold price is off 25%. How can you say that the gold price is high? Those people obviously have a shorter term perspective than producers, refiners, fabricators, and long-term investors. And you've got this situation that's there. The range last year was 1623 on the low side and around 2064 on an intraday basis, 2040 on a settlement basis. We expect that the ratio, the range this year will be somewhat higher. We're looking at maybe 1730, 1740, 1750 on the low end during the second and third quarters. But then we think that by the end of the year, the price will be rising sharply again and probably will be testing $2,000 with spikes up to perhaps as high as 2060 that we saw the spike in early March of 2022 after the Russian invasion. A lot of our expectations for gold prices have to do with our expectations for the economy, political environment, and the financial markets that compete with gold in the minds of investors. And I'll talk about that in a second. Longer term, we continue to expect much higher prices in 2024 and 2025, directly related to our expectations of economic activity. Meanwhile, there's a lot of interesting things being said that maybe aren't quite as accurate as they could be about gold. And we'll try to address some of the things about what's really going on in the gold market. Now, our economic outlook has been for some time that we thought there will be a recession. There will be many recessions in the future. Recessions come and go. Our expectation for some time has been that the recession was most likely to occur sometime between 2024 and 2026. That is still our expectation. We didn't think there would be a recession in 2022. There were a couple periods, a couple quarters of negative growth in the United States and a couple other industrialized economies in the first half of 2022. But then in the second half, you saw very strong growth. So that at the end of the day, U.S. GDP, I think for 2022 was about 2.1% real GDP. Our expectation for 2023 is somewhat slower growth, but again, continued growth. We still think that there could be a recession that it might emerge in the fourth quarter of this year, but we see it being more likely to occur in 2024, 2025. Now, I will say one thing. In 2008, our expectation was that we'd see a recession in 2009. And even when we were already into what became the official recessionary period in the first half of 2008, the recession actually started, I think, in the fourth quarter of 2007 back then. We were thinking that we would avoid a recession in 2008, partly because it was an election year. We figured that the Bush administration would do whatever it could to keep us out of a recession. They didn't do what they could. In fact, they didn't do a lot of things, and we had a very severe recession in 2007 to 2009. In fact, the worst recession since the Great Depression and World War II, at least until 2020. We had the big recession in 2020, and that was an anomaly because past recessions have been caused by economic constraints and financial issues. And in 2020, it was caused by the governments of the world shutting down due to the pandemic and shutting down their societies and their economies for a time. Steep recession in 2020, steep recovery in 2021. U.S. GDP was 5.9% in 2021 coming out of that recession year over year. Somewhat slower growth in 2022, 2023. Our expectation is still 2024, 2025 may see another recession. It could be pretty traumatic on the industrialized world. You probably would see the emerging economies avoid outright recessionary conditions, but continue to see some of the anemic growth that we've seen over the last 2 years in that region. But the industrialized world may see a recession. We have an enormous range of economic, financial market, and political issues that are threatening economic stability and could combine in some way to pull us together into a recession and a global financial crisis, similar to what we saw in 2007, 2011. It really, the recession and global initial crisis was 2007 to 2009, but then you had the sovereign debt issues in the European Union countries, and you had the downgrading of U.S. Treasury debt in 2011. So you had a very severe period of time for about 4 or 5 years, recovery going back. We have been asked a lot recently about the recent bank failures and whether or not this is the beginning of another round of bad times. And we've actually written some stuff, and we'll probably be writing more about comparing March of 2023 to March of 2008, and in fact, March of 2000. We had a recession in 2000, 2001, relatively short and shallow, but it was a recessionary period. And it came about because of a combination of factors, including the dot-com bubble bursting. The dot-com bubble was clear to come. As I wrote this week, it wasn't a black swan event. Anybody with, half a mind could see that valuing companies that had no plans, no ideas, a 3-page business plan at $500 million was not good economics and not good finance. It brought a recession, but that recession occurred 12 months after the dot-com bubble started to burst in March of 2000. Fast forward to 2008. In March of 2008, Bear Stearns went bust. And on a Sunday, the Treasury and Fed arranged for JP Morgan to take it over. There were various guarantees against financial losses for JP Morgan to take over Bear Stearns. The gold price, which had been around $780 at the beginning of 2008, broke above $1,000 for the first time on Monday, the 17th of March, the day after the takeover of Bear Stearns, which was insolvent. And a lot of people thought, this is it. And you had certain people who were still out there talking about $3,000 and $10,000 gold, saying gold's going to be $3,000 by Monday, by next Monday, and it's going to be $10,000 by Christmas. And they were pretty much wrong. Our expectation at the time was, we told our clients, okay, the price has broken over $1,000. Stop buying gold. We had been telling people to buy gold from November of 2000 into March of 2008. March of 2008, when the price broke above $1,000, we said, don't buy over $1,000. Wait until the price comes off and gets down to 900 or less. It actually got to $904 5 days later, that Friday. And it broke below $900 by April 1st and stayed below $900 for some time. It did get back over $1,000 later on in that period from 2008 to 2011. And it got up to 1900 something in September of 2011, about a month after the U.S. Treasury debt was downgraded for the first time in history. So our view back then was that the Bear Stearns crisis, which took gold over 1,000, was the foothills of a bigger problem, a bigger financial and economic and political crisis that we saw coming. And it did come. But, it really came in September of 2008 with the Lehman Brothers insolvency, where the Fed and the Treasury didn't step in. and Lehman Brothers was broken up and sold off to competitors, and a variety of other political and economic and financial market crises at that time in September of 2008. So we saw the Bear Stearns as the foothills, and we look at the Credit Suisse and the Silicon Valley Bank and Sovereign and First Republic of March 2023 as the foothills of a bigger crisis that probably is going to emerge 9 months or later from now. But it is on the horizon. There are a variety of problems that are there. We have a long list that we itemize in our monthly precious metals advisory. And we do see problems coming, which is why we see much higher gold prices in 2024 and 2025. And then we see things getting better and the price coming back off. Because it's not the end of the world. Now, these are U.S. GDP going back to 1850. And without boring you with the details, from like 1850 to 1919 or so, about the time the Fed was starting to become effective, you saw a lot of recessions that averaged 22 months in duration and were much larger. Since 1945, after the Fed, Roaring '20s, the Great Depression, and World War II, since 1945, about the same length of time, you've seen half as many recessions, less than half as many recessions, much more shallower, as you can see here, and shorter. Not 22 months in average, 10 months. Now that changed in 2008 to 2009. And we saw 2020, which was actually relatively short, but very deep by post-World War II standards, shallow by the standards of the 1870s, 1880s, 1890s, when we had depressions. And in stark contrast to the period from 1907, when we had a bank panic, where certain state-chartered banks had no assets behind their, they didn't have the deposits to cover what the script that they had written. 1907 bank panic to 1913, when the Fed was created, you had the U.S. economy not in a continual recession, but in a series of recessions that lasted about, 16 months out of 90 months. We were in a recession from 1907 to 1913. And that's why they created the Fed. It wasn't a nefarious thing. It was like people really got tired of having recessions and depressions and bank failures because the banks were being audited, or they were being supervised, or they were supposed to be supervised. They were supposed to be regulated and audited by the states, but they weren't because the states didn't have those resources. By the way, Silicon Valley Bank was a state-registered bank. And the state apparently wasn't paying too much attention to it. But I want to make this point. It's not the end of the world. We will have a recession. We will have financial crises. There will be issues in certain obscure portions of the debt market. Unlike what a lot of the gold bugs that try to get you to buy gold at premiums on the internet say, it's not going to be a failure of the U.S. Treasury debt market. The U.S. Treasury debt market's the last thing that's going to fail. It's going to be some obscure corner of the debt market, like, say, maybe a bank that is heavily lending out to very high-risk tech companies and the venture capitalist firms that throw money at outrageous valuations to those guys. But it is coming, and we do think that investors will see a range of political issues, domestic issues in the U.S., in Europe, in the U.K., in Russia, China, and other places. And they will see economic problems and recessionary conditions and excess labor and excess commercial real estate and excess manufacturing capacity starting to reemerge as they were prior to 2020. And financial market instability. In that kind of environment, the dollar actually may do well, but gold will do well alongside the dollar, the same way it did in 1979. So that's sort of the economic environment. I want to kick it over to Rohit now and let him talk about some of the details. Let's see if I can figure out how to do this. If I put on my glasses, it will help. Okay, take it away, Rohit. You are muted.
Thank you, Jeff. Good morning. I'm going to be speaking about a variety of topics and sections of the gold market. So let's start here with gold investment demand. Gold investment demand in 2022 stood at about 26 million ounces, which was up around 5% from 2021 levels. On average, during 2021 and 2022, you've seen gold investment demand stand at about 25 million ounces, which is pretty high by historic standards. And when we've looked at this statistically, investment demand above 20 million ounces has typically correlated with strong or rising gold prices. That said, investment demand in 2021, 2022 was off pretty sharply from the nearly 40 million ounces in net gold investment demand in 2020. And this setup in investment demand that we've been seeing over the past few years is reflected in prices. So you have seen gold prices at historically high levels, but they have struggled to break above the highs seen in 2020 in any sustainable way. This year, we expect investment demand to remain similarly healthy as it was in the past couple of years. We forecast a net gold investment demand of about 26.4 million ounces, and we expect that this would continue to support gold prices as it has in the past 2 years, and could potentially push gold prices higher than the levels that we've seen in the past couple of years. So that let's talk about gold investment demand in 2022. As mentioned before, you had strong gold investment demand last year. There were a number of factors that helped to support gold investment demand, and there were a few which acted as headwinds to investment demand as well. So the year started with investors being particularly concerned about inflation. And so you had a lot of investors get into the gold market and add gold to their portfolios as an inflation hedge. We also saw weakness in equity markets around the world, which drove investors towards gold as a portfolio diversifier. And then towards the end of February, you had Russia invade Ukraine, and that drove up gold investment demand as a safe haven asset. So there was a lot of strength in gold investment demand during the first couple of months of 2022. And then in March, you started to see the Fed tighten monetary policy much more aggressively than what the Fed itself had projected, as well as what the market was expecting. Now, this had mixed implications for gold investment demand. You had more shorter-term tactical investors getting out of gold as they were out of all other assets as well in the face of rising bond yields and a stronger US dollar. But then you had longer-term, more price-sensitive investors, those that invest in gold coins and bars, actually using that weakness in gold prices as a buying opportunity. They looked around, they saw a lot of problems with the global economy and various issues with rising political tensions across the globe. And so they used that softness in gold prices that was experienced during the second and third quarters as a buying opportunity, which ended up helping gold investment demand during 2022. Heading into 2023, a recession is a major concern. It's front and center for a lot of investors. Um, that concern feeds into an expectation that monetary policy will pivot over the course of this year. And so both these factors and these expectations and concerns are supportive of gold investment demand. Then you have inflation, which is expected to soften over the course of the year, but still remain high compared to where it's been over the past several decades. This both the softening as well as the expectation that it would remain high compared to where it's been in the past few decades is expected to be positive for gold investment demand. So with regards to the softening of inflation, that feeds into the expectation that it could result in monetary authorities around the world pulling back from raising interest rates. And then you have the expectation that inflation will still remain high compared to where it's been recently, driving investors to add gold as an inflation hedge. So in both forms, this is supportive of gold investment demand. Then you have elevated levels of cross-border political tensions, which we think is an extremely important factor in driving gold investment demand for a variety of reasons. For one, this could be one of the main reasons why you get driven towards a recession. The trade tariffs and the blockages being put between trade between countries and regions, we think is something that is already been weighing on economic growth and could continue to weigh on economic growth, helping to create that recession. You also, not only would this deterioration of relationships between countries help to create a recession, but it is also likely to make it difficult to recover from one because of the hostilities and the lack of cooperation between countries would make it much more challenging when it comes time to try and recover from any kind of recessionary conditions. With regards to factors that could potentially be headwinds to gold investment demand, one is the high price of gold, which would typically hurt the more price sensitive sectors of gold investment demand, such as coin demand. There could be some pullback in demand from these buyers. They would it's not that they would not buy at high prices, but they're unlikely to buy in a price environment as we've seen in the past couple of months, where prices have been rising sharply. They may look more for stability, even if that is at higher price levels. And the fact that monetary policy will remain restrictive over the course of this year is again something that could act as a headwind to gold investment demand. So the next few slides talk about various factors that we think will influence gold investment demand. So starting here with inflation, our own expectation is that inflation will soften over the course of this year, that the ride lower will not be a smooth one, but would be bumpy, as we've seen in recent data where there are periods when it tends to spike up. And so we expect a similar pattern to follow over the rest of the year as well. The reason why we believe inflation will soften is because you have restrictive monetary policy across the globe, and a lot of that started last year, and it would take some time for it to start having an effect on inflation as well as the economy. And we believe that we'd start seeing that over the course of this year. You also have tighter financial conditions, in part because of the restrictive monetary policy, and in part because of the recent concerns that we've seen around the collapse in those three regional US banks, the demise of Credit Suisse. There's concerns about whether there's contagion from these recent events. And so that would result in tighter financial conditions, which would then soften demand and help to curb inflation. Another thing you've been seeing over the past few months is an easing of supply chain bottlenecks. So this was a major factor in driving inflation higher over the past couple of years, and that is beginning to ease. We expect that it would continue to ease as we move forward. And so that should take some of the supply side pressures off inflation. And then we also expect that on the demand side, demand both for services as well as goods will soften over the course of the year, in part because of the impact of monetary policy and having a more fuller effect, and also because concerns about job losses, if not actual job losses, would also somewhat contribute to a reduction on the demand side. So we think that collectively all of these factors will weigh on inflation. There are still a lot of risks that could cause inflation to rise. You have the Russia-Ukraine war, which was a major reason for inflation to be supported last year. It's still on. It could still create problems on the inflation side. COVID was another factor that played an important role in driving up inflation. It's been put on the back burner now, but there's no way to know for sure that this will not become an issue in the coming quarters. You will see sporadic supply constraints as you did with poultry and eggs in the last few months. Similar problems could arise. You have strong inflation in the services sector, which is tied to the resilient labor market. And so while there is an expectation that this will slow and soften over the course of the year, there is a chance that, at least based on recent data, that this may not happen. So there are risks to inflation rising or stagnating, but we think that between the risks for inflation rising or stagnating and for inflation declining, the factors contributing to a softness in inflation are likely to win out versus the ones which are likely to push inflation higher in the future. A recession. So there are many reasons why there's a concern about a recession. Obviously, the restrictive monetary policy is an obvious reason why there might be concerns about a recession. There's been a pullback in the fiscal stimulus that was seen around the time of COVID, which played an important role in driving economic growth for the last few years. There's been a pullback in that stimulus, so that again is expected to contribute to these fears of a recession. And then you have these elevated cross-border tensions, which I spoke about on the previous slide, which could create a recessionary environment. CPM Group's own base case scenario is that we expect a sharp slowdown in economic growth this year. We may avert a recession altogether during 2023, with the potential for a recession in 2024, 2025. So the depth and timing of the recession, in our opinion, would depend to a large extent on all those factors mentioned at the top of this slide, but also on what monetary policy does going forward. So you could expect if monetary policy plays out as various central banks, based on various central banks' projections of what they expect monetary policy to do, then we don't expect a sharp or a deep recession. It would probably be a shallow, possibly a short, shallow recession. If inflation does in fact stagnate, or if it does start rising over the course of this year, that would force central banks to tighten policy further, and that could in fact result in a deeper, possibly sooner, longer recession. So it would depend on, I guess, primarily what happens with inflation and how central banks decide to deal with that over the next several quarters. Fed's policy and the market's expectation of Fed policy, there's been a widening gap here. The Fed is still projecting a 25 basis points increase in the federal funds rate. and it expects and projects to hold the federal funds rate constant at least through the end of this year. The market, meanwhile, does not expect the Fed to raise interest rates anymore, and has been pricing in anywhere between 50 to 75 basis points in cuts during the second half of this year. So if the Fed does in fact stick to its plan, that could potentially result in a repricing of a lot of assets across the board, including gold. And if the market is correct and the Fed does in fact have to reduce interest rates during the second half of this year, then the reason for why the Fed is reducing interest rates would matter to gold. So if it is reducing interest rates because it thinks that inflation is, can be brought under control with the monetary policy that they've put into effect over the last year, then that would not necessarily be very supportive of gold investment demand and gold prices. But if it is in fact pulling back on interest rates because it's growing concerned about economic growth, then that is something that could be more supportive of gold investment demand and gold prices. So this slide shows various factors that influence gold investment demand, and the purchase of gold as an inflation hedge, safe haven, currency hedge. And as can be seen on this chart, most of those factors, we believe, will be supportive of gold investment demand during the current year. And so this would also, in our opinion, be supportive of gold prices during the current year. So what you're looking at here is gold held by ETFs. Last year saw the second consecutive year during which gold ETF holdings declined. The rate of decline was sharply down. So it was about half of what it was in 2021. We had a roughly 5 million ounce net reduction in gold ETF holdings in 2022. That net reduction has continued into the first 2 months of this year as well. This could change as the year progresses. But what is probably more important is that despite 2 consecutive years of net declines, the total amount of gold held by ETFs is still higher than any period prior to 2020. So there's still a lot of gold being held by these products, and something that would be supportive of gold prices. This is a chart that shows gold coin demand. Gold coin demand has been healthy and strong over the past 3 years. Investors have been buying these products. Any softness in prices has been used as a buying opportunity. This year as well, you could continue to see healthy demand, maybe a little bit softer than what it was last year, but still healthy compared to most years that we've seen historically. So again, something we believe which would be supportive of gold prices and gold investment demand this year. So with that, let's move on to supply. Total supply, which includes mine supply as well as scrap supply, stood at 126.6 million ounces in 2022. And this 2022 was the second consecutive year that total supply rose. But despite that increase, total supply was at the end of 2022 was still lower than levels seen in 2019. And one of the primary reasons why total supply has not been able to rise, at least through the end of last year, above levels seen prior to the pandemic was because it's been weighed down by weakness on the mine production side. So recently, COVID-related disruptions and then recovery from that was one factor that weighed on mine production. But the problems related to the mining industry predate COVID. One of the biggest issues that the mining industry had been facing was a reduced amount of investment in developing new projects or in setting up expansion projects. And another factor that weighed on mine production over the past couple of years, or the past few years, has been a suspension of some major mines, either due to political reasons, depending on which countries these mines were being operated in, or due to technical mine-specific reasons. The lack of expansion projects and the lack of new capacity coming on stream has basically taken away any buffer for such disruptions, which are typical and ongoing in the mining industry. So the lack of that buffer has been one of the main reasons why mine production has struggled to rise in the past few years. So when you look at 2022, the primary driver of the increase in mine production was China. China's output rose by about 1.4 million ounces in 2022, which was driven by a recovery in Chinese gold output due to the recovery of output from their Shandong mines, which there were disruptions in 2021 due to safety-related issues. There were also a couple of projects that came on stream during the year, which helped to support gold mine production in China. This 1.4 million ounce net increase in Chinese gold investment demand, Chinese gold supply, was roughly around 4.6 times the total net increase in global total supply, global total mine production. So another way to think about this is that in the absence of an increase in Chinese mine production during 2022, 2022 would have been yet another year when mine production would have softened because of weakness and suspension in mining operations across various major gold mining countries. Scrap supply is been rising over the past few years. It's been essentially supported by strong prices of gold, and it's scrap supply that has really helped to support total supply as well. So in addition to gold, the strength in gold prices, to which scrap supply is extremely sensitive, limited government support in some countries during COVID was another factor that helped to increase gold scrap supply. You did see a selling of gold to compensate for lost income in countries where the governments did not provide generous support, as was seen in some Western countries. So this was something that helped to support scrap supply as well as support total supply of gold over the past few years. In 2023, we forecast total supply to reach 129 million ounces. We expect both scrap supply as well as mine supply to rise. The increase in mine supply that we're expecting in 2023 is really a recovery in production from some of the mines that were suspended for one reason or another during 2021 or 2022. It's not so much the result of expansion projects or new capacity coming on stream. And then scrap supply, as has been seen in the past few years, is primarily being supported and driven higher by that expectation of strong gold prices. So as mentioned before, spending in the mining sector, this is the exploration spending, and this had declined during the last decade. It bottomed out around 2016. There was a gradual increase since 2017, some weakness again during the COVID period of 2020. And it's really picked up momentum since 2021, 2022, again, primarily because of strength in metal prices. What is important and worth noting here is the proportion of spending made towards the gold mining sector. So as of 2022, 53% of total dollars spent on exploration went towards the gold mining sector. So this is a big positive for mine supply in the medium to long term. Both the increase in the amount of spending in the mining sector, as well as the increased proportion of that spending towards gold, should help to build capacity in the next decade or so, which should relieve the mine supply side of some of the problems that we've seen in recent years, where the suspension of major mines resulted in fairly sharp declines in mine production of gold. So this chart shows a new mine capacity that has been coming on stream, and it was down last year, probably bottomed out. We expect that it would rise this year as well as next year. That said, despite those increases, they're still lower than levels seen in the last decade. As spending increases in this sector, new mine capacity should be expected to come on stream, but that would really not show up for another 7 to 10 years at least. So it's something that would influence mine supply in the longer term, but not necessarily have any major positive impact in the short term. All-in sustaining costs on a production-weighted basis reached record high levels at the end of 2022. This is not entirely surprising. The strength in gold prices that we've been seeing over the past few years, with an annual average gold price last year actually at record high levels, coupled with a lot of inflationary pressure in the broader environment as well. Both those factors collectively helped to push all-in sustaining costs to record levels last year. The increase in gold prices is a bigger influence on the move higher in these costs. You can see that even prior to inflation taking off, there's a pretty close correlation between the increase in gold prices and the increase in costs. And this is, again, a very typical scenario and a typical situation where you tend to see cost rise when the metals prices go up. This is not exclusive to gold. You see this across the mining sector. One reason why this happens is because mining companies tend to divert their attention towards mining lower grade ores. There is a higher cost to mining those lower grade ores, but the higher price of metals tends to compensate for the higher costs, allowing mining companies to still earn a healthy margin. So it makes economic sense for mining companies to do this. And therefore, there's that close correlation between gold prices and costs. Another factor that tends to push costs higher at a time when metals prices are going up is because of the increased demand for various inputs, whether that's labor or it's various supplies that are needed for mining. The increased demand for mining pushes up the costs of these inputs, and as a result, you see an inflation in the costs of mining at a time when metal prices go up. Going forward, since our expectation is for gold prices to continue rising, we expect that costs will also rise in coming years. Our expectation is also that broader inflation will soften from the peak that we saw in 2022. So that should help to take some of the upward pressure off that we saw in 2022. But it would not be a major contributor to deflating these costs as we move forward. So this chart shows you the margin between cash costs and gold prices. And they were at record high levels in recent years. They've come off from those record high levels, but they're still extremely high. And this helps to explain why mining companies would focus on mining lower grade ores at a time when metal prices are up, because the higher costs can be absorbed by the much higher increase in metal prices. So with that, we move on to fabrication demand. Fabrication demand stood at 90.4 million ounces in 2022, which was off around 1% from 2021 levels. If you exclude 2020, 2022's gold fabrication demand was the lowest since 2012. There were a lot of factors that hurt gold fabrication demand last year. One was the high US dollar gold price during the first and the fourth quarter of last year. Gold jewelry demand tends to typically be very sensitive to gold prices. So the strength in gold prices during those 2 quarters resulted in dampening demand from that sector. We also had a strong US dollar, which made gold prices in the domestic currencies of countries outside of the United States a lot more, which then again hurt gold fabrication demand. You also saw a shift, especially in Western countries, a shift in demand from goods towards services, um, spending in a shift in spending from goods towards services, which again was a negative for gold fabrication demand, whether it be from jewelry or electronics. But the most important reason why you saw weakness in gold fabrication demand last year was the decline in demand from China. Chinese demand was off primarily because of weakness in economic growth, which was coming from the zero COVID policy, which created this start-stop economy in China. Weakness in the Chinese economy obviously put discretionary purchases like gold jewelry on the back burner. There was also reduced socializing because of the zero COVID policy, which again reduced the need for the purchase of jewelry. And you had factories being shuttered from time to time, which directly affected gold fabrication demand in a negative way. This year, we expect gold fabrication demand to reach 92.6 million ounces, which is up about 2.5% from 2022 levels. The primary factor that is supporting gold fabrication demand this year would be an increase in Chinese demand, essentially a reversal of all of the negative factors that we saw last year. Of the 2.2 million ounce net increase that we expect in gold fabrication demand this year, 76% of that we think will come from China. Demand is also expected to rise in other countries, but at a much slower pace than what we've seen in recent years. High gold prices, we think, will continue to act as a headwind to gold fabrication demand this year. That said, the relative softness in the US dollar and the potential for a further decline in the US dollar is something that we think will help to offset that strength in gold prices during 2023. So with that, we move on to central bank gold demand. Central banks were net buyers of about 10.2 million ounces of gold in 2022. This was the 15th consecutive year that central banks were net buyers. There were a total of 22 central banks that were net buyers, which was around in line with the number of central banks that have been net buyers in recent years. So, and of those 22, only 9 central banks bought more than 500,000 ounces of gold. And essentially, these 9 central banks accounted for 91% of the total purchases made during 2022. So this highlights a couple of things. One is that the purchases were extremely concentrated, which is, again, something that we see year after year. It's just a handful of central banks that make large purchases. And also that it was not any more of a broad-based increase in demand from central banks. The 22 central banks, this was the number of central banks buying was no more than what we've seen in the past few years. So nothing too spectacular in terms of, it was healthy demand, but nothing that was outstanding that we saw in 2022. Since 2008, when central banks turned net buyers, the central banks have absorbed around 172 million ounces of gold on a net basis, which represents around 73% of the net sales that we saw during 1989 through 2007. Now, that reabsorption has played an important role clearly in supporting gold prices. But since 2007 through 2022, gold stock, which is basically the difference between newly refined supply and fabrication demand, rose by around 570 million ounces, which is roughly 3 times the amount of gold that was that central banks had absorbed between 2008 and 2022. So this helps to explain to some extent why, despite the strength in central bank gold demand, gold prices have not risen more strongly. It's primarily a result of a much larger increase in the gold stock, um, which has prevented gold prices from rising more strongly than they could have. Last year, the largest buyer of gold was Turkey. You also saw central banks of China as well as Russia re-entering the markets as net buyers. This is important from the gold market's point of view because both these central banks had suspended buying for some time. They've re-entered the market as buyers. They've been extremely large buyers in the past, so they could provide um, support to net gold investment demand in 2023. The strength that we saw in Turkish gold demand last year by the central bank was to a large extent driven by a huge influx of both dollars as well as euros into Turkey, because Turkey was acting as a trade channel on behalf of Russia following the war. So a lot of those that forex was diverted towards the buying of gold. You also have Turkey has been since around 2017 taking in gold from its citizens by issuing them gold bonds and gold certificates. Of all the gold that they have taken in since 2017, around 40% of that is in the form of gold taken in from its own citizens. In 2022, the largest seller of gold was Kazakhstan. They reduced their holdings by around 1.6 million ounces, and Kazakhstan alone accounted for around 70% of the total reduction. You had political as well as economic problems within the country that caused this selling. A lot of that selling did occur in the beginning and the end of the year, so the timing of those sales was pretty good in terms of what gold prices were doing at the time. In 2023, we expect central banks to remain net buyers, adding roughly around 10 million ounces of gold to their holdings on a net basis. Emerging market central banks, we believe, will remain the main buyers of gold as they continue to diversify their assets away from forex and as they continue to add gold to their holdings as a long-term store of value. The high price of gold this year, we think, will act as a headwind to central bank gold demand. That said, while historically central bank net purchases have been had a fairly negative correlation to the price of gold, in recent years, despite the high price of gold, we have continued to see healthy demand from central banks. We expect that trend to continue this year as well. If we see extremely strong increases in gold prices, you could see central banks pull back on the amount of purchasing that they're doing, or maybe even turn net sellers for a short period of time. But if prices stabilize or soften, we think that central banks will step up their purchases in those months or during those periods. So with that, I will pass this back to Jeff to talk about the next couple of slides and then take it back from him after.
Thank you, Rohit. Thank you all for sticking around. I just have a few comments, and Rohit actually covered a lot of the ground that talking about. But I guess there are two big themes that you keep hearing about gold and central banks. One is that central banks are rushing into gold, and the other one is that central banks are rushing out of the dollar. And I'll kick it back to Rohit to talk about central banks and their dollar foreign exchange holdings. But I wanted to make a few points, and again, Rohit's already made them. If you look at the number of central banks in the world, there were 8 that were selling gold last year. Kazakhstan was the largest and represented the vast majority of the gold that was sold. As she said, they sold in the beginning and the end of the year. Kazakhstan was racked with some political protests that threatened to overturn the government in January of 2022. Russia sent in paratroopers and other military to help quell the protests and keep it from overthrowing the government. In addition to that, Kazakhstan is heavily dependent on trade with Russia and energy exports for its foreign exchange. It suffered during the year, so it sold some of its gold to cover itself during these times of political and economic problems. Australia was the next largest, and I will point out, they sold about 416,000 ounces of gold last year, and they had bought about 400,000 ounces of gold, not quite 400,000 ounces of gold in 2021. Australia had sold a tremendous amount of its gold in the 80s and 90s. And had gotten down to about 1.8 million ounces of gold left in its monetary reserves. Last year, it bought about 370,000 ounces or so, or in 2021, it bought about 370,000 ounces. And then in last year, it sold most of what it had bought, took itself back down to about 40,000 ounces higher than it had been at the beginning of 2021. Again, Rohit talked about this. There were 22 central banks that sold gold, that bought gold last year out of 180 some odd countries or so. So there hasn't been a mad rush into gold. And as Rohit said, if you look at it, 9 of them bought more than 500,000 ounces. Russia bought about 500,000 ounces from domestic production. I'll show you some charts in a second. Turkey was the largest. China bought 2 million ounces in November and December. India bought 1 million ounces. The other countries, there are 6 countries out of that 9, were Islamic governments. And when people say, well, central banks are rushing into gold, what they should say is in 2022, Islamic central banks were rushing into gold. And it may reflect more about things going on politically and economically within the Islamic world, from Libya all the way to Indonesia, than it does in the gold market or the international currency regime system. India has, a minority Muslim population that has a heavy influence in the gold market within India. But basically what you saw were 9 countries buying significant amounts of gold last year, each for specific reasons, 6 of which were Islamic countries. China, they bought 2 million ounces and added it to their monetary reserves in November and December. They bought about another 1.4 million ounces in January and February of this year. The People's Bank of China, like many central banks, will provide gold and silver trading services for entities within the country. And over the course of China, as Rohit discussed earlier, over the course of 2022, you saw very strong demand in China for gold investment products and in jewelry in the first quarter. And then in the second and third and fourth quarters, you saw very weak demand. And there was gold that was coming into the market from refiners, from institutional investors who were selling gold, and from retailers and wholesalers of gold investment products that was not necessarily readily absorbed by other private sector buyers within the Chinese economy. China has a policy that the government would like to see any gold that's sold within China bought within China. They don't necessarily want to see that gold leaving the country. But over the course of, say, April through November, December of last year, you weren't seeing private sector entities absorbing the gold that was being sold from other private sector entities and institutional investors. So that was building up in a side account, trading account that the People's Bank of China was holding. When the price of gold went from $2,060 in March to $1,624 in early November, the People's Bank of China said, well, let's buy 1 million ounces of that gold that's sitting in that special trading account. And then they bought another 1 million ounces in December. So I think that that's what you saw, and it's probably, it's perhaps a less attractive story than saying, oh, there's all of this gold that's building up in a special non-monetary account at the People's Bank of China. It was indicative of weak demand and rising supply in China in the market, in the gold market last year. So a little bit of caution about the idea that central banks are rushing into gold. Now, in Russia, the Russian central bank, the Central Bank of Russia, had stopped reporting its monetary balances. It reported in February, it reported its January balances. And then just recently, they updated their data through the year. And you can see, the blue line is total what they call international reserves. We call monetary reserves. And it includes gold, foreign exchange, small amounts of what they call a reserve position in the International Monetary Fund, and special drawing rights, which are issued by the International Monetary Fund, and basically are intra-central bank assets that you can transfer. And you can see they fell really from February of 2022 into about August, and then they started to rise a little bit, but they're down. Now, the orange line is foreign exchange. Much of the foreign exchange reserves, about 2/3 of it, is frozen in overseas banks. Russia keeps, like most central banks, Russia keeps its gold within Russia, and it keeps its foreign exchange in overseas banks. About 2/3 of that seems to have been frozen by sanctions after Russia invaded Ukraine. The other big chunk was in Chinese yuan at the People's Bank of China. And when the war began and the assets were frozen, the Russian central bank asked for its yuan to be converted into other currencies and given to it. And the People's Bank of China said, well, we have a problem. We don't have sanctions against you, but the sanctions that are out there say that if other entity trades with the Central Bank of Russia, they could come under international sanctions. So to give you your money back would be putting the People's Bank of China at risk for international sanctions. So we're not going to do that. It's one of several things that have occurred that if you look below the surface, you'll see that the relationship between Russia and China is not exactly one of equals, and it's not exactly one of a close brotherhood. It's a friendship of convenience. China, very telling. I'll tell you another data point. During the meeting between President Xi Jinping of China and President Putin of Russia last week, Russia had various documents ready to be signed, including one called, I can't remember the name, but it's basically natural gas from Eastern Siberia to be built, to have a pipeline built and ship that natural gas and sell it through Mongolia into China. And Russia had an agreement drawn up for that. It's number 2 transaction to sell natural gas from Eastern Siberia into China. And Xi Jinping decided not to sign it. Well, he didn't decide it on the spot. They knew they weren't going to sign it because basically that natural gas is coming from land that in the 19th century, Tsarist Russia took in a war from China. So the Chinese government looking at revanchist land grabs, saying, you won Ukraine back because you say that in the 19th century it was part of Russia. We won Taiwan back because we say that in 19th century it was part of Russia, and the early 20th century it was part of China. We could also make a revanchist claim that parts of former Soviet Union, Russia, and Far East actually belonged to China because you took them in the 19th century war. So the idea of us signing an agreement to buy natural gas from you, taken out of land that you took from us in a war 180 years ago, let's not sign that agreement. So the relationship between Russia and China is not nearly as friendly as some people would have you believe. China has its own best interests in mind. A lot of those foreign exchange in Russia are still tied up, either directly through sanctions or through the risks of suffering from sanctions on your own. And then there's the gold, which is at the bottom. And if you look at the gold close up, you see it's changed dramatically. There were some sales of gold in March of last year to finance operations in foreign exchange and generate foreign exchange at a time when the sanctions were kicking in. The Russian central bank did rebuild some of those reserves, but it has been using those gold reserves to generate foreign exchange reserves as needed over the course of the year. In the end, they were up about 500,000 ounces for the full year. That's what central banks use gold for. I'm going to now try to pass the screen back to Rohit and let him take us back to the question and answer period. Rohit?
Thanks, Ruth. So what this slide is showing us is a central bank reserve composition. So if you look at the chart on the right-hand side, you can see that as of 2022, gold accounted for roughly 14% of global central bank reserves. And this share has been rising over the past few years, and there's two reasons for that. One is the ongoing net purchases that we've been seeing being made by central banks, and the other is the rising price of gold. We expect both these trends to continue going forward. We expect central banks to continue buying gold on a net basis as well as gold prices to rise. But despite that, we do not expect or forecast that gold's share of central bank reserves will go back to anything that it was in the 70s, 80s, or even in the early 90s. And one of the main reasons for that is if you look at the chart on the left-hand side, there's this massive increase, which is ongoing in Forex. So Forex reserves held by central banks reached record high levels in 2021, and you saw them come off a little bit in 2022, but still very high by historic standards. And the weakness that we saw in 2022 can be explained to some extent by central banks, especially emerging market central banks, selling some of this Forex to support their domestic currencies against the rising values of these reserve currencies, such as the dollar, euro, yen, against the domestic currencies of these developing economies. This chart here illustrates the fact that central banks are not dumping the US dollar. So the US dollar has, in fact, been fairly steady. If you look back all the way to 1995, it's been fairly steady around 60% of central bank Forex reserves. You did see an increase in the late 90s, early 2000s, which was really more a result of a transition in Europe towards the euro. But since the mid 2000s, if you look back, it's really been holding fairly steady at 60%. So there hasn't been this massive decline in dollars held by central banks. And we don't expect this to happen either. One of the main reasons for that is that the USD is still the primary currency for both global trade finance as well as the currency in which most debt has been priced around the globe. So we don't really expect the US dollar to be reduced in the holdings of these central banks. So with that, we conclude the presentation. You can buy this book at CPM Group store. We will be having our Silver Yearbook presentation launch on the 9th of May, and then our Platinum Group Metals Yearbook launch at the end of July on the 25th. With that, we can open it up for questions.
Thank you, Rohit. You might want to go to the next page, which has a little bit more information about CPM Group stuff. Just leave that up. But questions, and Carlos Sanchez, one of the other partners at CPM Group, will help with the questions.
Okay, so we have several questions, and actually the questions that were sent in advance, a lot of them were answered, talked about. So we'll begin with this a question that was sent in. How have the recent bank problems caused CPM to change the gold price forecast for this year? And what is that gold price forecast?
I had talked about the idea that we expect the range of gold prices to be somewhat higher this year than it was last year. I gave a range of maybe 1720, 1740 on the low end, up to about $2,050, $2,060 on the high end. It didn't actually give a projection for the annual average price, other than to say that we thought that it would be higher, and that it probably would be a new record. The reality is that we're looking for right now our most recently published projection for 2023's price is up about 3.9% to about 1875 on average for the year. So we're really thinking about a much higher price. Rohit, do you want to address the issue as to whether the bank issues have changed our gold price outlook, or should I?
I mean, we factored in, financial stability concerns in that gold price average that you read out. There is, a risk to the upside if there is, in fact, a contagion effect from what we saw in the last few weeks. But it is somewhat factored into that price already.
I'll say one thing. I was giving an interview a couple of weeks ago, and fellow said, well, the last time we interviewed you was like in October of 2022. And at the time, you had this litany of things that probably are going to cause investors to want to buy more gold in 2023. Very similar to the lists that Rohit went through at the beginning of this presentation this morning. But they pointed out that one of the things that we emphasized was the idea that you could have increased volatility and financial instability in the banking system, not only in the United States, but also in other countries. So we have been expecting problems in the banking system, not catastrophic problems. We're not looking for, 1,300 banks to disappear over the next 12 months. But we are looking for weak links in the international banking system and in the domestic banking system. And as I said at the beginning, this is the first shot, and we wouldn't be surprised to see if things kind of get papered over for a few months. But we do think that at some point later, it's going to continue to be a problem. And more problematic is how monetary authorities and government treasuries and finance ministries deal with it. In 2008, there was some catastrophic missteps on the part of regulators in dealing with the banking crisis. And we would hope that they would avoid that this time, but we had hoped that they would have avoided it in 2008, and they clearly, consciously decided not to avoid making those missteps. And we're still living with the consequences of that. So we have been assuming banking industry problems for years. So it has, the fact that they started to arrive in March of this year has affected our price expectations for gold a little bit, but it was already kind of baked into it. Next question.
Next question. Do you believe that central banks will continue to accumulate gold, and could this put a floor price on gold?
Our expectation is that central banks will continue to accumulate gold. As Rohit pointed out, central banks are more price sensitive and have a higher price elasticity than do private investors. One of the myths that you hear in the gold market is that the People's Bank of China did not report its gold holdings from 2019 until late last year. And that's not true. They actually did report their holdings on a monthly basis. And every month they said, we haven't bought any gold. If you look at it, the Central Bank of China was buying gold when the price was 1,250 to 1,350 into the middle part of 2019. When the price went above 1350 to 15, and then it's 16, and then 18, and then 2000, the People's Bank of China stopped buying. It's very interesting that when the price got that back down to 1623 in November, they said, okay, it's not 1350, it's not 1250, but it is off 25% from the peak earlier this year. Let's buy. So we do think that, and we have seen this over the last few years, central banks willing to buy gold, more gold at a higher price than in the past. So they have lost some of their price sensitivity. They continue to want to diversify their monetary reserves. It's not a wholesale rush into gold, but you are seeing a steady amount of gold being bought by, as Rohit said, a relatively stable number of countries over the last several years. And that's probably going to continue. It does help build a base on the price, but because central banks tend to be better value investors than private investors, if they see the gold price falling, they will wait to see how low the price is going to go before they start buying. So, perhaps better base building comes from the private sector investors who are willing to buy more gold at a higher price.
Okay. A related question to central bank buying. Why are Western central banks not buying gold?
Well, primarily because they have a lot of gold already. If you look at that chart that Rohit had of central bank purchases and sales going back to 1950, a lot of the Western central banks had accumulated large amounts of gold 1950s, 1960s into 1971. And they did that partly because gold was used for international trade and capital flow settlements. So when you got into the post-Bretton Woods system of floating exchange rates, you had a lot of central banks that had 75, 85, 95, 99% of their foreign exchange reserves in gold. And they were the ones that were selling from really the late 1970s into 2005. That period of large sales were those central banks saying, we need to diversify our monetary reserves. We have 90, 95, 99% of our monetary reserves in gold. We need to sell some gold and get dollars and other currencies in our monetary reserve. So the Swiss National Bank and the Bank of England were very public in saying, we have, in the case of Swiss, we have 86 million ounces of gold. It's 99% of our reserves. We're going to sell half of it because we don't want to have more than 50% of our monetary reserves in gold. And if the gold if the value of our gold reserves rise above 50% in the future, because the dollar's falling and gold's rising or whatever, for whatever reasons, we will sell more gold. The British said we had 19, 20 million ounces of gold and we will sell half of it. And interestingly, I mean, there's all kinds of myths about the Bank of England sales. The Bank of England sales were agreed upon internally long before Gordon Brown was involved with the Chancellor of the Exchequer. This was an issue that had been decided in the early 90s, late 80s, early 90s. And the decision on the part of the Bank of England, after it opted out of the euro after the currency crisis of 1992, they said, like the Swiss, we will wait until after the euro comes into being on January 1st, 1979, before we start selling our gold. So it happened under Gordon Brown's watch, but the decision to sell was made years earlier. But he was a good trooper and he fell on the sword for it. Yeah. So these central banks still have a lot of gold. England still has 10 million ounces. Switzerland still has 40 some odd ounces, a million ounces. They don't need to buy more.
Okay, next question. What do you believe the impact of inflation is on gold miners?
You want to take that one, Robert?
Yeah, sure. So, I mean, as mentioned during the presentation, the broader inflationary pressures that we've seen over the past year, they have had a impact on driving up costs for mining companies. But what we've also seen is that the increase in costs that are being reported by these mining companies is really more the outcome of higher gold prices than it is the broader inflation problem that we've been seeing for the past year. And going forward as well, we expect mining company costs to continue rising from where they are right now. And that's, again, primarily based on the relation between those costs and gold prices, with some of that inflation expected to soften in the broader economy. That might actually take away some of that upward pressure on mining costs in the next few quarters.
Okay, next question. To what extent are cryptocurrencies taking demand away from gold, the attention?
Our view is that cryptocurrencies have taken a little bit of market away from gold, but that if you look at it over the last several years, a much larger distraction, if you will, of investor attention away from gold has been to the stock and bond markets. Now that changed dramatically in 2022, but our view is that cryptocurrencies have had a relatively minor effect of investors shifting from gold to cryptos. Because if you think about it logically, cryptos are the antithesis of gold. And we have been talking for some time, and we've done videos on the relationship between cryptocurrencies and gold. And you can go to cpmgroup.com. We have a video library where you can find some of these videos. We've talked about how we thought forever, since the advent of cryptos, we have said we thought that cryptos would be ultimately very good for gold because that the private crypto market would implode. It's full of problems and issues. And that ultimately people would say that, gee, that was like buying pet rocks or .com stocks or packaged mortgage securities in 2006, 2007. It wasn't the smartest thing to do. And we did a video late last year where we were going to talk about that, but we realized that the crypto market, just over the course of 2022, the crypto markets market cap, if you will, or float, had gone from $3 trillion to less than $1 trillion. It was about $890 billion by the end of last year, which means that the crypto market had already lost 2/3 of its value. If you look at where you see the profitability, the risk reward ratio, and you compare the risk reward ratio in cryptos to other assets, and you say, where do I see this kind of risk reward ratio? It's a slot machine. So our view about private cryptos is that, they've already proven that they're not really competitive with gold in terms of ways to preserve your wealth, and they'll continue to do that. There's a second issue, which is central bank digital currencies. And we also have done a video, I think it was on January 31st of this year. It is available at cpmgroup.com in our video library, where we talked about the advent of central bank digital currencies and how we don't think it's going to have a major impact in driving investors to gold, because at the end of the day, it's a change in the mechanism of money as opposed to a change in the nature of money. And it's akin to the changes that we've seen over the years from species to script to private bank notes to government bank notes to Federal Reserve bank notes to checks to credit cards to exchange electronic fund transfers via SWIFT and ACH. It's a change in the mechanisms of money. It's not a change in the nature. Now, there will be some people who will say, but, central bank digital currencies will give people, governments, so much extra information and control and knowledge about individuals. The reality is, if you think that it takes central bank or digital currencies for governments to know what you're doing, you really haven't been paying attention. That cat's been out of the bag and it's halfway down the road. So we don't see central bank digital currencies as having a major impact driving people toward gold. We do see private sector cryptocurrencies as having been a modest distraction that ultimately will be a very good advertisement for gold, because private sector cryptos are the antithesis of physical gold and silver.
You talk about the different investment vehicles for gold, physical gold, ETFs, mining shares. Which one, in your view, perhaps is the better investment?
It's hard to say what a better investment is. And, what CPM Group's policy or posture has been for decades is that a diversified portfolio of gold and precious metals makes sense. We've also said repeatedly, ad nauseum, for half a century, if you want to buy gold, buy gold. Physical gold is the best way to invest in physical gold. ETFs are very convenient, but you should not buy ETFs if you are buying gold as insurance against catastrophic failure of the economy or society. Your long-term bedrock, the base of your wealth, should be gold, physical gold that you own. ETFs, you own shares in an offshore company that the sole asset of which is physical gold. They're not readily exchangeable into physical gold. They are good for investing purposes and for capital appreciation purposes and for trading purposes, but they're not going to give you that bedrock in insurance. Mining equities also are very attractive in their own way, but you are taking on a variety of risks in terms of performance risks, security risks, national security risks, resource nationalism risks, operating risks, management risks that you don't have with physical gold. That doesn't mean that you should take those risks on with some of your portfolio and invest in companies that look very attractive to you. But you really need to do your homework, study the management, study the properties, and study the industry overall.
Okay, and last question, what is your view on the gold-silver ratio, gold S&P ratio, and other commodity ratios?
You want to take that, Rohit, or should I?
I didn't quite catch the question.
Question was the views between what are our views about ratios like the gold silver ratio, the gold S&P ratio, etc.
Oh, I could take the first stab and then you can elaborate on it if you want. So, I mean, we look at those ratios. Clearly, the gold silver ratio is something a lot of investors tend to look at and determine whether they should or should not be investing in either gold or silver. Our own opinion about that ratio is that it's simply the ratio of the two prices, that the ratio does not necessarily, the position of the ratio does not necessarily determine which way a particular metal's value is going to move. We've seen a lot of volatility in that ratio, especially the gold and silver ratio. So, I think our opinion on that ratio is that, yes, investors look at it. We mention it in our reports, but it's not a good gauge for forecasting which way the price of either of those metals is likely to move.
Okay. Well, if that's the last, I have nothing to add to that. If that is the last question, we will thank you all for participating again. Feel free to contact CPM Group at info@cpmgroup.com if you have more questions or if you want to talk about ways that we can help you understand these markets and invest effectively. We will be doing our silver yearbook and PGM yearbooks coming up, and we will extend you invitations to participate in those again. Feel free to visit our website, cpmgroup.com, to read about our various services and to watch those videos that I was talking about in terms of central bank digital currencies, private cryptocurrencies, their relationships with gold, and other issues that we've talked about in those videos. Thank you and have a good day.